All right, guys, it's March 2010, March 1st. It's time to tackle some trading. Okay, let's take a look at what we got here. We'll start out with the chart of the Emini S&P futures. And we called it. We said we would expect a market breakup today, some moderately bullish movement, and bam, here it is. So we see a nice strong close above the previous resistance peak. That's a very strong sign. As a general rule, we don't expect the market to run more than 10 days in any one direction. And from the pivot, we're up 1, 2, 3. So we're into this move about 3 days. And realistically, the most we could expect is another 7 tops. That doesn't mean it will run that much. It just is an estimate of how much it could run. I have some line studies prepared, some range studies, and we've seen this swing range before. So I'm talking about a pivot to pivot swing range, which we have seen this market repeat a couple of times. This is one of the smaller swing ranges. And again, we see a nice healthy move in those swing ranges. And again, we see this range kind of repeatedly across the market. If we were to get that swing range up, that's going to put us up. Now, how you draw that's up to you. If you go from the pivot, you've got another day up and you're looking at about 1125. So you'd have to be careful on 1125. If you kind of go from the common lows down in here, that'll put you up to about 1129, call it 1130. And I see an old support resistance zone right in there. Right in here we have the old resistance high and then the support pivot off of those candles, support lows. That puts you right up at around 1129, call it 1130. So watch for 1125 and 1130, and then we've got a major resistance zone out in here. And we have the potential to run a bigger range. So we've seen a larger swing range before. And here's an example of a strong swing range. And we've seen this range on multiple occasions back here. We've seen it here on the drop right here. So if we were to get a healthy swing range up, from the last swing low, that puts you up into that same 1130 zone. From the current swing low, you would have a hard time breaking 1150 to get up that range. So really what I would say is if you're heading towards a big swing range, watch 1150 as a solid resistance zone, and if it breaks beyond that, you're going to be suspect at about 1160. So really, as a trader, I am watching the near term, 1125 to 1130, and then beyond 1130, I'm watching 1150. So those will be critical points. Now, let's check up and see how we did on our quick trading ideas. We had the breakout trade on JAS stores, and we'll go ahead and bring that up. And what we had said is, hey, look, JAS stores had this nice little ascending triangle slash cup and handle type breakout, just strong upward pressure, and it broke up as we anticipated. It closed above the resistance, so we're at an all-time high for this, and it looks fantastic. And nice strong close. And again, we're into this move 1, 2, 3 days. A typical run is about 1, 2, 3, 4, 5, 6 days. And you could get even more. You could get a 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. You know, that's a really high-end move for any security. So I would expect a few more days up. And we had talked about targets at 40 and as high as about 42, 42.50 at the top of the channel. Now, if I had been triggered into this trade today, I would probably still have my sell limit out at 40, maybe 42-ish, and I would be trailing my stop loss, and I'd have my stop loss trailed below today's candlestick low. So you'd put a stop loss a few pennies, couple cents below the candlestick low. If you want to lose stop loss, you go back 1 or 2 candles, maybe even all the way back to the swing pivot. But you want to control your downside. You don't want to let a trade get away from you. So I'd go ahead and plan on putting a stop loss below today's candlestick low. That one worked out real well so far. And then the other security we had was the Castle, CAS, and we had talked about the pullback here, and we had put a buy stop above the candlestick high, a stop loss below the candlestick low, so let's kind of reincorporate what we had talked about was our original plan. And we said, hey, if it goes above the candlestick high, we'd like to buy. That's our confirmation. Well, bam, there it is. It breaks out. We have a nice strong move up, really strong move. We could watch for the gap to fill, and I would probably keep my sell limit at about 1250, and I would now raise my stop loss either to the candle low if you want to give it some room to breathe, but if you want to go ahead and remove and mitigate your risk as much as possible, bring your stop loss up to the price you paid for it, and then you're playing with house money. Now that'll work out okay. So that's panned out really well. So we're batting 1,000 so far. We picked the market direction. We nailed 2 stock directions. I would suspect we're going to see some continued upward movement. Now I want to talk to you a little bit about market pressures. And we talked about the S&P. These are the E-mini futures. And again, we're talking about more upside potential. I want to show you a correlation between the market and our US dollar, and then we'll tie in gold. So here is the dollar. And what I see on the dollar is it's had a strong rally, but I'm seeing slowing momentum. And I would probably expect this dollar, it's losing some strength. So we had a nice strong move up, but it's slowing down. It's failing to take out the high. We're seeing some downward movement in price. And on average, the dollar has lost its momentum, so it would not be uncommon for it to put into a corrective drop. And we can see that that trend has been violated, for example, and this trend is in the process of being violated. I would expect the dollar to drop, and if the dollar drops, that helps continue to drive the market higher. There's also a strong correlation between this and gold. So we go with the dollar, and I'm going to crack open gold, which is YG, yellow gold, YG space #F. That's the gold. And gold is coming off of a bottom. Now, if we have an inverted head and shoulders pattern here, and let me go ahead and draw this inverted head and shoulders pattern. So here's what you call left shoulder, and then here is the head, and this is the right shoulder. And what traders are looking for is a breakout above the neckline. Now, a breakout above the neckline is a very strong signal. And with the dollar dropping, you're more than likely going to see a rise in gold and a rise in the S&P index. So assuming the dollar drops, we're going to get a little bit of fuel added to the fire. So here's a quick trading idea for you. I ran a scan for breakouts, and what came up was a pattern on RGLD, Royal Gold. And we have a double bottom pattern forming here. So let me go ahead and draw this here for you. So here we have kind of the W, and the W stands for win, and we are seeing a breakout above resistance. So we could be looking to take advantage of the upward movement in price, and there's a lot of different ways you could take advantage of that upward movement in price. You could buy the stock itself, which would be at about $45, $46 a share. You could sell put options on it. You could do a bull put spread. You could do a variety of different trading strategies on that particular pattern. And what I'd like to do is we'll go ahead and look at some history here. And I want to show you that this is not just a random pattern. We're in a very strong trend zone. So we've got a major trend zone and a good double bottom pattern. We'd be looking for a breakout. We'd be looking for targets near term 47.50, 50, and 55. So that's a little bit easier type of trade pattern setup. And again, you could look to do something really, really simple. Like, let me go ahead and give you an idea of how we could trade this. I'm going to crack open a risk graph, and I'm going to put in Royal Gold RGLD, and I'm going to go with a bull put spread. So I'm going to do a bull put credit and talk to you a little bit about how I would plan that out. And my basic idea is that this thing is going to stay above 45, and I could go out and do an April bull put credit, and it would bring in $1.52 credit, and all this stock has to do is stay above the strike price of 45, and that's where we've seen the support become established. And this would only require $347 of margin requirement. That's your maximum risk is $347. And so as far as a percent yield goes, if this stock stays above the $45 strike price, then you would be looking at a maximum credit of 152 divided by the margin requirement of 347. That would give you a potential 43% yield on the capital used for that particular security. If it were to break to the downside, what you would do is you would unwrap the put that you sold and mitigate the loss there. So this idea here, let me show the chart and kind of minimize this so you can see this, is a bull put credit spread. And if the stock breaks up above the 45 and stays up in this neighborhood, which it looks like it's setting up to do, with a very nominal amount of money, I can create a nice, handsome return on investment. And then you could do that with 5 contracts or 10 contracts, but that's the basic idea. So we will catch up with you next time. And again, appreciate you coming out and hanging out with us. And good luck, good trading, and we'll see you tomorrow.